Saurabh Mukharjea, good morning. Thank you for joining us. We don't talk about real estate stocks, but a lot of real estate stocks actually have not done well. I mean, I just looked at what DLF has done, 20% up in quick time. Colte is at a record high. Obra is not looking bad. So real estate not today, tomorrow, not this year, not next year. But for someone who says, look, I've got patience for 3 years, does it make sense to buy the top 2, 3 real estate names?
I'm not so sure about residential real estate, but I think I agree with you. I think commercial real estate in India is a very viable asset class. There's clearly still a big shortage of high quality office space in the big cities in our country. And there's good reason to believe that a well-run commercial real estate play can generate yields of say 8, 9, 10%. And in that regard, I think commercial real estate is an asset class whose time hasn't yet come in India, and it's worth looking out for that. Now, whether the company you mentioned is the best play on it or not, I'm afraid I'm not the expert on the subject. But commercial real estate, I think, is a very interesting area to focus on. Residential, I'm still not sure. I still don't. I've been saying for 4 or 5 years, and I still take the point of view that there still isn't any affordability in residential real estate. And the fact that you've got a handful of developers who do a good job of residential real estate doesn't mean that the asset class itself is still viable.
Sort of morning, just wondering how much more this rally in banks can push forward. And for those who've missed the bus, is it too late to jump in, or do you think there are still banks out there which can be bought and you can still make that 15 to 30% return in say the next 3 to 4 months?
I think our frontline private sector banks. I think there is further scope for rallying here, because I think the NBFC sector will give up more share to the private sector banks in the next 12 months. We've seen some of it in the last 6-7 months as the cost of wholesale money has risen, and thus the cost of money for the NBFCs and HFCs has gone to a point where them losing market share to the private sector banks is, I think, but inevitable. But I think that cycle hasn't yet fully played out. My reckoning is on the other side of the elections, we'll get another bout of problems in the short-term money market, in the wholesale money market, and that will probably be the next trigger for another bout of market share to shift from NBFCs to the banks, to the private sector banks.
So-called disguise correction in consumer durables and consumer staples has already started. Autos have already taken it on the chin. Most of the auto companies and most of the consumer staple companies we are speaking to, they are officially using the word slow down. They're whispering it right now, but they're admitting it that business is slowing down. What does that mean for earnings? What does that mean for consumption? What does that mean for the economy?
One level, I don't think it's any bad thing. I mean, we're fairly accustomed in India to seeing auto demand cycles where demand in auto volumes is strong, say mid-teens, high teens for 3-4 years, mid-teens, high teens growth for 3-4 years, and then a slowdown which lasts for 2-3 years. We're probably halfway through that auto slowdown, both in cars and in trucks. So at one level, there's nothing surprising here. It is but healthy to have a auto cycle where you grow strongly for 3-4 years and then slow down for a couple of years. Where I think the demand situation is still pretty healthy is small ticket consumption. So whether it's FMCG, apparel, restaurants, QSR, I think the small ticket consumption picture is fairly healthy. And my reckoning is the recent budget that we went through. I think that should be a major stimulus to consumption over the next 12 months. The middle class tax cuts, PM Kisan, Maha Pension Yojana, all these loan waivers that we've heard about over the last 12 months, the fact that GST's ambit has been pulled back so aggressively. So I think there's enough there to sustain small ticket consumption in our country. Obviously, sooner or later, we do need a revival in jobs. You can't indefinitely consume even small ticket stuff without a job creation cycle. But at least for the next 12 months, there's reasonable visibility that small ticket consumption will hold up even as auto continues to stutter and sputter.
So, hi there, morning. Amid the US-China talks, the kind of raw material prices, the kind of global moves that we've seen, what is your take on metals?
Look, I'm not an expert on the subject, and I think as you're alluding to in your question, the number of imponderables in that picture are multiple. Exactly how deep is the China slowdown? Is it a slowdown? Is it a revival? I think that itself is a mystery for most of us sitting outside China. But what does look relatively clear is that across the Western world, whether it's America, whether it's Europe, you do have a economic slowdown coming through. Both the Fed in December and again recently the European Central Bank and the Bank of England, they're all signaling a slowdown in economic growth. If you have a slowdown in economic growth in the world's big economic blocks, that can't be good news for metal prices. So whilst the China piece is a black box and a bit of a mystery to me, the data that's coming from North America and from Europe does suggest a slowdown, which should lead to tempering in metal prices. Indian metals and mining stocks, I think, shows 70% correlation with the prices on the LME. So I think the implications there are self-evident.
What is it that you're making of this overall March rally? I mean, another 300 points, we'll be sitting at an all-time high. We've seen a solid recovery coming from the broader markets as well. And look at the kind of FI participation. I guess it's all that liquidity inflow which has kept us afloat. Do you sense that, for a market which a month back was just so circumspect on what's going to happen with elections, it's going to be volatile, it's been a little too smooth, or and would you say that it's time to tread with caution right now, and perhaps some sanity will return in the next few days to come in the run up to the elections?
So I think the way to think about the rally is the global risk on rally started on something like 22nd December, when the Fed signaled, when the Powell signaled that he was, excuse me, when he was abandoning his tightening monetary policy stance. I think between 22nd December to say end of February, equity markets across the world rallied by around 10%. We didn't participate in that. We started catching up with that rally over the last 3-4 weeks or so. And in that regard, we've fallen behind global equity markets by a distance. But I do believe that, as I've said for the last year and a half, there's very little reason to say that the Indian index as a whole has got lots of upside in it. Our earnings growth has been sclerotic. 7.5% is the 10-year CAGR on Nifty earnings. Last 6-7 years, we've barely seen anything more than 6-7% earnings growth. And to have that sort of situation as a backdrop and have an index trading at the sorts of PE multiples we saw in early 2008, I think does send alarm bells ringing in my head with regards to the index as a whole. Where there are opportunities is it's relatively clear in our country that the consumption engine is the only engine that can fire. Because there is a middle class which is rising in the world and wants to spend more, and B, because there's a government in place which wants to pump consumption up. So the consumption engine is going to help us deal with this elongated bout of no capex growth, and in that context, specific bouts of stocks, whether it's retail banks, whether it is consumption plays, works. It's also relatively clear that the currency is overvalued. I think 68, 69 to the rupee also doesn't make sense. Export growth has once again slowed down. And if you assume that the fair value of the currency is around 75, that would suggest there's a fair tailwind coming for exporters. So IT and pharma should do well as the export-oriented sectors get a currency fillip in the next 12 months. So there are pockets in the Indian economy where you can make money: consumption, private sector, banks, exporters. But very little reason for me to sit here on your channel's program and say that the index as a whole is undervalued and should be running up any moment now on the back of either global macro or election news.
Okay, that's an interesting point. And Saurabh, let's keep it a little bit more specific then. You had spoken about some classic compounders in the past. I believe identified a name like an Abbott India. What else in this market is sticking out to you that you'd like to share?
So I think let's take a sector by sector. I think in FMCG, the structural compounders, the consistent compounders, companies with long, strong track records are well known. I think we've discussed Asian Paints on your channel before. We've discussed some companies like Marico before, and the So commentary I often hear around these sorts of names or around, say, an HDFC Bank is, hey, the P multiple or the price to book multiple is very rich, and there should be a correction in it. The challenge that that one has with these stocks is their compounding in their business, the underlying compounding in the business is so consistent. And if you look at Asian Plains, cash flow per share has compounded at 21-22% over 1 year, 3 year, 5 year, 10 year, 20 year. The underlying compounding in this business is so strong that the PE multiple almost gets rendered irrelevant over, say, time periods of, say, any 3 years or longer. So anybody who tries to say, I will sell Asian Paints or an HDFC Bank because it looks expensive on conventional price metrics, runs into the challenge that the compounding in the business sort of swamps his bearishness. So in consumption, thankfully in our country we have a handful of these companies, I would say half a dozen, who keep compounding at a healthy rate. Banking, HDFC Bank is the obvious compounder, but I think there's reason to believe there are other companies who will join that list. I think the recent bout of change in Indian banking, change at the top of ICICI, of Axis Bank, I think is very encouraging, and we've been doing a lot of work to see are there other compounders we can dig out there who can have as bright a future as HDFC Bank. Similarly, in the pharma space, it's a beaten down sector. It's been thrashed badly in the last 3 years, but the fundamentals in terms of ROCs is very strong. Cash generation is strong, and the last 3-4 months of channel checks that we are doing suggest that the pharma recovery, an export-driven pharma recovery, should be round the corner. And this is a sector where, off the top of my head, I can think of 4 or 5 names where the ROCs are north of 25%, and there are strong moats around those businesses. So pharma is another sector where we're looking forward to discovering. I think you named one company, Abbott, but I think there's probably 1 or 2 more there who could make it into that compounders list. So if you look at India, it's not as if you have to go and buy the Nifty tomorrow morning to make money. There's at least dozen companies who've consistently compounded your wealth year in, year out for the last 5, 10, 15 years. And it's a shame to ignore them and try to pick some company with a low PE multiple, which will potentially, believe, rally tomorrow morning, or buy the Nifty. There's very little reason to buy the index as a whole, because I think the indexes I've written about and I've spoken about, the index as a whole isn't that promising. It contains a lot of weak companies who've struggled to grow in the past. You're much better off focusing on companies of the ilk of an Asian Paints or an HDFC Bank.
Talking about these names because I just have a sheet, just a coincidence. The P multiple of Asian Paints is 65. Abbott, even though the return ratios are more than 38, 39%, they are trading the stock is trading at a P multiple of 40. So, Saurabh, what are the chances that if you buy an Asian Paints and if you buy something like an Abbott, for next 3 years, you may not actually get even market beating returns? I mean, they may grow, but the level at which you're buying them now, it just limits your next 3-year stock market potential or 3-year stock return.
Sure. So one way to think about PE multiples, and it's quite important to develop a mental framework which allows you to rationalize PE multiples. Typically, if you look at most stocks in our country, most of these sorts of names that we're discussing, over a 10-year period, either the PE multiple halves or it doubles. If the PE multiple doubles over 10 years, it gives you a 7% compounding just on the PE multiple. If it halves, it's minus 7%. Now, if you have an underlying EPS growth engine, if you have an underlying growth engine in the company which chugs along at, say, 25%, even if the PE multiple halves in the next 10 years, you get 25 minus 7, you get around 18%. Most of these companies we're discussing, Nikunj, have dividend yields of around 2-3%. So assume 25% earnings growth sustains, which is the underlying premise of looking at these sorts of companies, Asian Paints or the Abbotts of the world. Assume that the EPS growth sustains at 25 odd percent. PE multiple comes off by 50%, halves. 25 minus 7, 18%. At the dividend yield, you're making 20% total shareholder returns with a high degree of visibility, with low volatility, consistently across time. That is, I think, as good an outcome as you can get in large and mid-cap investing in one of the world's largest stock markets. That's why I called my book Coffee Can Investing, the low-risk route to stupendous wealth. This is your best bet in India of consistently chugging out good returns year after year over very long periods of time. I completely agree with you, though, that there is a risk that the PE multiples could come off. But as long as the earnings engine sustains, you will make healthy money.
Lovely chatting with you. Thanks so much for taking time out and joining in with your idea of where the markets are headed, as well as the
Thank you.
overall
My pleasure.
macro
Thanks.
environment.